Have you ever wondered how a farmer knows what price they'll receive for their corn crop months before harvest? Or how a cereal manufacturer knows what it might pay for corn long before the crop is harvested? Or how investors can profit when the price of silver, oil, or wheat rises or falls? The answer often involves something called a futures contract. Futures contracts play a major role in global markets. They help businesses manage risk, allow producers to lock in prices, and give investors a way to speculate on future price movements. In this video, we'll explain what futures contracts are, how they work, why businesses use them, how investors trade them, and the risks involved. A futures contract is an agreement to buy or sell an asset at a predetermined price on a future date. The asset could be corn, wheat, coffee, oil, natural gas, gold, silver, currencies, or even stock market indexes. The agreement is made today, but settlement happens later. Think of it as agreeing on a price now for something that will be delivered in the future. Futures contracts were originally created to help businesses manage risk. Before futures existed, farmers faced a major problem. They would plant crops months before harvest, but had no idea what prices would be when the crops were ready to sell. This uncertainty made planning difficult. Futures contracts allowed farmers and buyers to agree on prices in advance, reducing uncertainty for both sides. Let's look at a simple example. Imagine a farmer plants corn in spring. The crop won't be harvested for another 6 months. Today, corn is selling for $5 per bushel. The farmer worries that prices could fall before harvest. To reduce that risk, the farmer sells futures contracts at $5 per bushel. This effectively locks in today's price. 6 months later, suppose corn prices have fallen to $3 per bushel. The farmer receives less for the physical crop. However, the futures contract generates a gain that helps offset the lower selling price. This process is known as hedging. The goal isn't to maximize profits. The goal is to reduce uncertainty. Buyers use futures too. Imagine a cereal manufacturer that needs millions of bushels of corn every year. The company worries prices could rise. To reduce this risk, it buys corn futures contracts. Now both the farmer and the manufacturer have greater certainty about future prices. Many people refer to futures contracts as paper assets. This is because most futures traders never own the physical commodity. If you buy silver futures, you don't immediately receive silver bars. If you buy corn futures, truckloads of corn don't arrive at your home. Instead, you own a financial contract whose value changes based on the price of the underlying asset. By comparison, physical assets include things such as silver bullion, gold coins, farmland, property, and machinery. With physical assets, you own the asset directly. With futures contracts, you own an agreement based on the future price of the asset. Although many futures contracts allow physical delivery, most traders close their positions before the contract expires. As a result, very few investors ever take delivery of the underlying commodity. Today, futures markets are primarily used for hedging and speculation. Many investors use futures simply to speculate on prices. For example, an investor may believe silver prices will rise. Instead of buying physical silver, they buy a silver futures contract. If silver rises, the contract becomes more valuable. The investor can then sell the contract and keep the profit. When an investor expects prices to rise, they are said to be going long. Long positions profit when prices rise. This is similar to buying shares and hoping they increase in value. Futures also make it easy to profit from falling prices. This is known as going short. Suppose an investor believes corn prices will fall from $5 to $4 per bushel. They can sell a futures contract first and buy it back later at the lower price. If prices fall as expected, they make a profit. Short positions profit when prices fall. One reason futures are popular is that traders do not need to pay the full value of a contract up front. Instead, they provide a smaller deposit known as margin. Think of margin as a security deposit. A trader may control $50,000 worth of silver with only $5,000 deposited. This creates leverage. Leverage increases both profits and losses. If the market moves in your favor, gains can be amplified, but if prices move against you, losses can grow quickly. If losses reduce your account below the required minimum level, your broker may issue a margin call. A margin call requires you to deposit additional funds or close the position. If you fail to do so, the broker may close the trade automatically. This is one of the biggest risks associated with futures trading. A temporary market movement can force an investor out of a position permanently. Let's compare futures with some other investments. Shares represent ownership in a company. ETFs represent a basket of investments. Physical silver represents ownership of silver itself. Futures contracts represent an agreement based on a future price. Unlike shares, bonds, or rental property, futures generally do not generate income. For most investors, futures are considered a specialist tool rather than a core long-term investment. Futures contracts are an important part of global markets. They help farmers protect crop prices. They help businesses lock in future costs. They allow investors to profit from rising or falling prices. Unlike physical assets, futures are often referred to as paper assets because they provide exposure to price movements without requiring ownership of the underlying commodity. Investors can go long if they expect prices to rise. They can go short if they expect prices to fall. However, futures also involve leverage, margin requirements, and the possibility of margin calls. Understanding futures can help you better understand how commodity and financial markets operate, even if you never trade a futures contract yourself. This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions.